Welcome back to the deep dive, where we try to turn all that information overload into those satisfying aha moments. Today, we're stepping onto the grand stage of California real estate. Now, imagine a really complex dance, right, where every move, every single turn is meticulously planned out. That choreography, that's the contract. And these aren't just, pieces of paper. They are the actual legal framework that secures dreams, protects big investments, and honestly shapes entire careers. So what is it that transforms a simple handshake into a legally binding commitment? And how do you, as an aspiring real estate professional, become not just someone who signs on the dotted line, but a true contract conductor?
Indeed. Today's deep dive is all about that fundamental blueprint of real estate transactions, the contracts themselves. We'll be drawing insights from, well, various sources, from detailed guides on the California Residential Purchase Agreement, the RPACA, to really practical tips on navigating those crucial clauses and contingencies. Our mission really is to distill the essential elements that make these agreements legally binding and enforceable. We'll also explore how different listing agreements shape the agent-client relationship and break down the key components and safeguards in purchase contracts. We'll even touch on some broader contractual principles that underpin, all major deals, whether it's a simple residential sale or a massive construction project, because understanding these layers of protection is what truly empowers you.
That's exactly right. By the end of this deep dive, you won't just understand the legal jargon, you'll understand why it matters, how it protects everyone involved, and how mastering this knowledge makes you a really invaluable asset in the dynamic California real estate landscape. Get ready, because here's where it gets really interesting.
The foundational pillars, what makes any contract legally binding?
So let's start with the absolute bedrock. Before we even dive into the specifics of real estate, what are those universal essential elements that make any agreement, in any field, legally binding and enforceable? What's that fundamental recipe?
That's a critical point right there, and it's absolutely foundational knowledge. For any contract to be valid and enforceable, whether we're talking about, say, a multi-million-dollar development deal or just a simple agreement to paint a house, it has to meet several key requirements. These are offer, acceptance, legality, consideration, and mutual consent. Think of them like the 5 non-negotiable ingredients that formalize the deal. If even one is missing, you don't have a legally valid contract. Simple as that.
Okay, 5 ingredients. Let's break those down. Offer first.
Right. First up, the offer. This needs to be a clear proposal of specific terms. It's not just a casual suggestion. It has to be precise. And for real estate, it's absolutely imperative that this offer is always in writing and signed by the buyer to be legally valid. No verbal offers count here. It meticulously outlines what the buyer is proposing to purchase, at what price, and under what specific conditions. It's really the initial move that sets the whole transaction in motion, laying out the exact terms for the seller to consider. Without that clear, written offer, you're not even off the starting blocks in a real estate deal.
Got it. Written, specific. What's next? Acceptance.
Exactly. Following the offer, you need acceptance. And this means an unconditional agreement to every single one of the offer's terms. This is crucial. If the seller makes any change to the offer, it doesn't matter how minor, it doesn't count as acceptance. Instead, it instantly transforms into what we call a counteroffer.
Ah, so it voids the original offer.
Precisely. It voids the original offer and puts the ball back in the buyer's court. And just like the offer, this acceptance must also be in writing and signed by all parties involved, both buyer and seller, to ensure it's enforceable. This written confirmation is your ultimate safeguard against disputes later about whether a deal was truly struck.
Okay. Offer, acceptance, legality.
That sounds straightforward.
It mostly is. The third pillar is legality of purpose. The contract's objective has to be lawful. You simply cannot use a contract to engage in illegal activities. For example, trying to buy a property to run an illegal gambling operation. That contract's void.
Right.
It's void from the outset because the law won't enforce agreements made for unlawful purposes. This just ensures that the transaction itself is compliant with all applicable laws and regulations, protecting everyone involved.
Makes sense. Then, consideration. What exactly does that mean? Consideration. This refers to something of value exchanged between the parties. In most real estate deals, it's pretty simple. Typically money from the buyer and the property itself from the seller. Each party has to give up something of value, or at least promise to do so, for the contract to be valid.
Like a quid pro quo.
Exactly, the quid pro quo of the agreement. Without this exchange, without each party getting something of value in return for their promise, the contract isn't recognized as legally binding. There's no underlying reason for either party to perform.
Okay, that leaves mutual consent, the meeting of the minds.
Yes, mutual consent, often famously called a meeting of the minds. This means both parties must willingly and knowingly agree to the terms. They have to fully understand and assent to them. So no deception, no coercion, no duress, and no fundamental misunderstanding of the core terms. Both the buyer and seller need to be on the same page with full awareness and agreement for the contract to be truly valid. This element ensures the agreement is genuinely voluntary and reflects both parties' true intentions.
So it really sounds like a handshake, and a verbal yes just won't cut it in the legal world, especially with something as huge as real estate. My word isn't my bond here, unless it's written down.
You've absolutely got it. And that brings us straight to a critical California-specific principle, the statute of frauds. Now, this name is a bit misleading. It isn't really about preventing deception in the sense of lying. It's more about requiring certain types of agreements to be in writing to prevent fraudulent claims of agreements that maybe never actually happen.
Okay.
So in California real estate, this means agreements like, say, a lease for more than 1 year, any agreement for the sale of real property or an interest in it, and even employment agreements to find a purchaser of property. All of these must be in writing to be enforceable. Think of it as a legal safeguard.
A safeguard for significant transactions.
Yep. Exactly. To ensure they're well documented and not left to fuzzy memories or verbal disputes. And the real insight here isn't just that it must be in writing. It's that in real estate, the absence of a clear written agreement isn't just bad practice, it's a legal nullity. You literally can't rely on anything unwritten. It makes your documentation absolutely crucial, as important as the deal itself.
Wow.
Furthermore, it's not just the initial contract that needs writing. Any modifications, any addenda or supplements to these agreements also have to be in writing and signed by all parties to be legally enforceable. This is a super crucial point because even small changes, if they're not formally documented, could lead to big disagreements later or even render an entire clause unenforceable. Anything not in writing is simply not enforceable. Meticulous record-keeping and formal amendment processes are absolutely essential for you as a real estate professional in California.
Okay, let's really unpack this for California specifically then. When we talk about buying or selling property here, you mentioned one document that serves as the absolute cornerstone, the California Residential Purchase Agreement, the RPACA.
Right.
What makes this document so central, such a powerhouse?
Well, the RPACA is essentially the go-to document for almost all residential real estate transactions in California. It's really far from being just a single-purpose form. It's a truly multifunctional blueprint that serves several critical roles, basically centralizing the entire process. It acts as the buyer's formal offer to purchase, right? A proposal with all the specific terms clearly laid out. Then, upon final acceptance by the seller, it immediately transforms into a completed contract, legally binding both parties to its terms.
Okay, so offer and contract. What else?
Well, beyond that, it serves as a receipt for the earnest money deposit. That's that crucial piece showing the buyer's commitment. It also provides joint escrow instructions. This directs the escrow holder on precisely how to manage the transaction's financial and legal aspects. You know, how funds are dispersed, documents recorded, everything. The RPACA also clearly outlines mediation and arbitration agreements, defining how potential disputes will be handled. We'll definitely dive into that later.
Important stuff.
Very. It confirms agency relationships, clarifying who represents whom, which is absolutely crucial for ethical practice and avoiding conflicts of interest. And importantly for agents listening, it includes an irrevocable assignment of compensation to brokers. This ensures you get paid for your services as agreed. Its incredibly detailed nature is designed to cover most issues in a typical residential sale, which also means extensive modifications should generally be avoided by agents. Why?
Let me guess. Practicing law without a license.
Exactly. Dabbling too much in legal modifications can stray into the unauthorized practice of law. That's strictly for licensed attorneys. Your expertise as an agent is facilitation, negotiation, guidance, not legal drafting.
Wow, okay. That's a lot of hats for one document to wear. So when you actually look inside the RPACA, what are the key details you'd find that make it such a comprehensive roadmap? What should an aspiring agent be looking for immediately?
Absolutely. Beyond those general requirements for a valid contract we just talked about, the RPACA specifies critical details that make it a really robust roadmap. It explicitly includes all the buyer and seller details, clearly identifying every party involved, no ambiguity there. There's also a precise property description, could be the street address, or more formally, a legal description along with the assessor's parcel number, the APN. This ensures zero confusion about which property is being sold.
And the money side. Price, deposit.
Crucially, yes, it sets forth the agreed-upon purchase price, the exact amount the buyer will pay. It also meticulously covers the earnest money deposit, which, as you mentioned, is typically 1% to 3% of the purchase price here in California. This deposit, a significant sign of the buyer's serious intent, is generally given to the agent submitting the offer. Then it's placed into either a broker's trust account or a neutral escrow account. And there are rules around timing.
Right, like how quickly it has to be deposited.
Exactly. It must be disposed of properly by the third business day after receipt, unless the parties specifically agree to something else in writing within the contract. For instance, the contract might authorize holding the check uncashed until, say, a backup offer becomes primary, or maybe until an inspection contingency is removed. It gives flexibility but maintains transparency. And even something like a post-dated check, while not illegal, must be disclosed to the seller. It can certainly affect their decision, right? It impacts their perception of the buyer's immediate readiness.
Makes sense. What about timelines?
Yes, the RPACA clearly states the closing date. This is usually negotiated to be somewhere between 30 to 60 days from the signing of the agreement. This provides a clear timeline for everyone to work toward securing financing, coordinating movers, all that. The whole document, really, is designed to provide clarity and protection. It aims to prevent misunderstandings by spelling out the rights and responsibilities of both the buyer and the seller. This level of detail provides, honestly, tremendous peace of mind, knowing that every crucial aspect is down in writing and agreed upon.
Protecting your clients navigating clauses and contingencies in real estate.
Okay, so the RPACA lays out that foundational agreement. But real estate deals, as we all know, can be full of twists and turns. Unexpected things pop up. That's where contingencies come in, right? Acting as crucial safety nets, especially for buyers. So what exactly is a contingency clause, and how do they function as protectors? And maybe what happens if you skip them?
Right? Contingencies. Think of them as conditions that must be met before the real estate sale can actually proceed. They essentially protect the buyer from various risks by giving them the right to back out of the contract, usually without legal consequences, if specific standards aren't met within a negotiated time frame.
Like escape hatches.
Exactly, escape hatches, or you could think of them as if-then statements built into the contract. These clauses are conditional, obviously, based on specific events happening or not happening. And they always include clear, specific deadlines. That's key. If the conditions aren't met within that time frame, the contract can become null and void. This allows the buyer to recover their earnest money deposit and just walk away from the deal. It's a vital mechanism for risk management in a transaction as significant as buying property. And skipping them. Well, skipping them means the buyer is essentially taking on all those potential risks, inspection issues, appraisal shortfalls, financing problems, sight unseen. It can be incredibly perilous.
That makes perfect sense. Can you walk us through some of the most common contingency clauses that buyers in California rely on, the ones we absolutely need to know?
Certainly. There are, I'd say, 5 critical contingency clauses that are frequently used to protect buyers in California. Each one addresses a different facet of risk in a real estate transaction. First, and arguably the most important, is the home or land inspection contingency. This is crucial for buyers, especially when you're looking at properties that might carry higher inherent risks, maybe older homes, properties on hillsides, or places that have been vacant for a while. This clause allows the buyer to back out of the contract without penalty if a professional home inspection reveals significant defects within a specified time frame.
And lenders often want this too, right?
Oh, absolutely. Lenders often require these inspections because they can uncover serious, costly, or even dangerous issues. Things like asbestos, termites, hidden flood damage, mold, or severe structural problems that could really jeopardize the property's value or even its habitability. And as an agent, you advise your buyer to actively do their own digging during this period too. Check public records, like with the LA Department of Building and Safety, for past issues or permits related to the property. Now, here's where the ethical compass for agents really comes into play. In really hot, competitive markets, we sometimes see buyers feeling immense pressure to waive inspection contingencies just to make their offer look more attractive to a seller.
Oh yeah, I've heard of that. Risky.
It's a grave risk. It can lead to unforeseen and incredibly expensive repairs down the road, potentially jeopardizing the buyer's entire investment and their financial future. An agent's ethical duty includes strongly advising their clients against waiving this crucial protection, even if it means potentially losing out on that specific competitive offer.
Your priority has to be the client's long-term well-being and financial safety, always. Your job is to protect them, not just close the deal at any cost.
Okay, so inspection contingency is number 1. What's next?
Our second key contingency is the appraisal at purchase price contingency. This is absolutely essential for buyers using financing, which is most buyers, or really for anyone buying in volatile markets where property values might be fluctuating rapidly. This clause allows the buyer to withdraw from the contract if the property's appraised value comes in lower than the agreed upon purchase price.
Because the bank won't lend more than it's worth. Exactly. The reason it's so vital is that lenders typically won't lend more than a property's appraised value, regardless of what you agreed to pay. So if the appraisal falls short, the seller then faces a choice. Either lower the price to match the appraisal, or the buyer can walk away from the deal and get their earnest money deposit back without penalty. And to adapt and connect this, think about that earnest money deposit again, that 1% to 3% of the purchase price put into a neutral account. That deposit signals the buyer's seriousness. But this appraisal contingency ensures that money is returned if the property doesn't appraise. It's a crucial buffer.
Protecting their initial investment.
Right. It protects their deposit and ensures they don't overpay based on the assessed market value. It prevents them from being stuck with an underappraised property and an unworkable loan situation.
Okay, inspection, appraisal. What's number 3?
The third one is the permitting or feasibility contingency. Now, this clause applies primarily to vacant or maybe partially developed lots, rather than existing homes. It allows a buyer to back out if a feasibility study or survey reveals that the costs of things like city permit fees, utility hookup charges, maybe installing a septic system or a well, are unacceptable. Or maybe it reveals the lot simply cannot support the type or size of structures the buyer plans to build.
So making sure their vision is actually possible.
Precisely. It ensures the buyer's vision for the property is actually viable, both legally and financially, before they fully commit to the purchase. It prevents that nightmare scenario where someone buys land only to discover later their development plans are impossible or prohibitively expensive.
Makes sense for land. What else?
Next, we have the survey or subdivision contingency. This is also particularly vital for undeveloped land, but it can definitely apply to developed properties too, especially if there are concerns about boundary lines or easements. It allows the buyer to terminate the contract if a property survey reveals, say, less acreage than the seller stated, or if it uncovers undesirable easements or restrictive covenants that weren't disclosed or are unacceptable to the buyer.
Restrictive covenants, like rules about what you can build.
Exactly. Restrictive covenants can significantly impact how a property can be used or developed. They can dictate everything from building setbacks, architectural styles, even what kind of fence you can have, or prohibiting certain types of vehicles from being stored on the property. This clause ensures the buyer understands all these limitations and can use the property as intended without unexpected legal hurdles cropping up later.
Okay, 4 down. What's the 5th common one?
And finally, the 5th one is the financing contingency, sometimes called the mortgage contingency. This protects the buyer if they are unable to secure the necessary mortgage loan within the agreed-upon timeframe. Simple as that. It prevents the deal from moving forward if predetermined financial criteria aren't met. It acts as a crucial buffer, giving the buyer sufficient time to actually secure the funding they need.
And if they can't get the loan?
If financing falls through, maybe the buyer's loan application is denied, or they can't get the interest rate they were expecting or needed, the buyer isn't penalized. They get their earnest money back. This can even include clauses for needing to sell another property first to qualify for the new loan, which is a very common scenario for many homeowners who are upgrading or downsizing. Now, speaking to California, here's a TA Corner detail that's pretty unique to our state. California has some, well, notoriously complex real estate laws. And one unique aspect of contingencies here is the requirement for a specific contingency removal form.
Oh, so it's not automatic when the time runs out.
No, not at all. Unlike many other states, in California, the buyer must explicitly complete and file this form to officially lift the contingency restraints and allow the sale to proceed. It's a proactive step. If the buyer doesn't sign and submit this release within the specified time, the seller can then serve something called a notice to buyer to perform. If the buyer still doesn't perform after receiving that notice, then the seller gains the right to cancel the contract and potentially keep the earnest money deposit. This mechanism ensures clear communication and keeps the transaction timeline moving. It forces the buyer to actively commit or formally step away based on the contingency outcome.
Okay, so buyers are pretty well protected by these contingencies if they use them correctly. But what about the seller side of the equation? It's not just about what the buyer discovers, right? California law puts significant disclosure obligations on sellers, too. What are these critical disclosures? Why are they so important for an agent to really grasp?
You've hit on another absolute cornerstone of California real estate: mandatory seller disclosures. These are designed to ensure buyers are fully informed about the property and its surrounding environment. The whole goal is to prevent post-sale surprises and hopefully avoid subsequent disputes. For agents, understanding these is paramount because you are often the conduit delivering this information and explaining its significance. Sellers of 1 to 4 residential units have substantial responsibilities here. Some key ones include: first, the Transfer Disclosure Statement, TDS, and the Natural Hazards Disclosure, NHD statement. These are generally required for sellers of 1 to 4 residential units unless specific exemptions apply if they court-ordered sales, foreclosures, transfers between co-owners, things like that. It's really important to understand these forms are not warranties. They aren't guarantees, nor are they considered part of the contract itself, but they must be delivered to the buyer. What do they cover? The TDS covers known defects and material facts about the property condition, leaky roof, foundation issues, appliance malfunctions, etc. The NHD identifies whether the property is located in various designated natural hazard zones, flood zones, fire zones, earthquake fault zones. As an agent, your role isn't just to hand over the paper, but to ensure your client, whether buyer or seller, understands its significance. It's the seller's candid snapshot of the property's condition and environmental risks.
Okay, TDS and NHD. What else is crucial?
Then there's the lead-based paint disclosure. This is actually mandated by federal law, not just state. It requires sellers of residential properties built before 1978 to provide a specific notice, disclose any known lead paint hazards on the property, and give a lead hazard information pamphlet to the buyer. This is crucial for health protection, especially for families with young children, ensuring buyers are aware of potential environmental risks. California also mandates disclosure if the property is located in specific natural hazard zones. We mentioned the NHD covers this, but it includes things like earthquake fault zones, seismic hazard zones, and special flood hazard areas designated by FEMA areas where flood insurance is often required. Sellers must also disclose if the property is in an inundation zone, meaning areas subject to flooding from dam failure, or if it's in a state fire responsibility area known as an SRA.
Fire zones are a big one in California.
Huge. For properties in SRAs, buyers must be informed about the availability of fire protection services and any specific maintenance requirements needed to reduce fire risk, like brush clearance. These disclosures are vital given California's diverse geography and the associated risks. There are others too. The death on premises disclosure. Sellers must disclose if a death occurred on the property within the last 3 years. The Megan's Law disclosure informs buyers about their right to access public information on registered sex offenders in the area. There's also the real estate tax disclosure. This gives buyers a heads up about supplemental property tax bills, which can hit shortly after purchase and affect future tax obligations, sometimes causing sticker shock if buyers aren't prepared.
Any others related to the property itself?
Yes, the water-conserving fixtures disclosure. This details the status of low-flow toilets and shower heads. Non-compliant fixtures might need replacement if the buyer undertakes certain renovations, so it's good to know up front. And maybe most importantly, beyond all these specific statutory forms, sellers are always obligated to disclose any known adverse material facts about the property, even if it isn't covered by a specific form.
Like what?
This could include things like past insurance claims that might affect the property's future insurability or increase the cost of insurance. It really emphasizes the seller's broad duty of transparency. It's about full disclosure, period. Anything that could materially affect the value or desirability of the property.
What's fascinating here, you touched on it earlier, is that even the delivery time of these disclosures can trigger cancellation rates, right? So it's not just what is disclosed, but when it gets to the buyer.
You've absolutely nailed it. The timing of delivery for these key disclosures is incredibly important, and yes, it can indeed trigger additional cancellation periods for the buyer. It's a procedural safeguard. If the Transfer Disclosure Statement, PDS, the Natural Hazards Disclosure, NHD, or those lead-based paint disclosures are delivered after the buyer has already signed the purchase agreement.
After the offer is accepted.
Right, after the contract is formed. Then it triggers a specific cancellation period. This period is typically 3 days if the documents are delivered in person, or 5 days if they're delivered by mail. During this window, the buyer has the right to review the disclosures. If they find something unsatisfactory or unexpectedly problematic based on that new information, they can cancel the contract without penalty.
But what if they get them before signing the offer?
Good question. If the buyer receives these same disclosures before they sign the purchase agreement, then there's no additional cancellation period triggered just by the disclosures themselves. The law presumes the buyer had the chance to review them before making their offer and factor that information in. And crucially, California law explicitly states that neither buyers nor sellers can waive their right to receive these statutorily required disclosures. You can't contract around it. This really reinforces the state's strong commitment to consumer protection and informed decision-making in real estate transactions. It ensures a fundamental level of transparency that just cannot be bypassed, no matter how hot the market gets.
Beyond the purchase understanding, other critical real estate agreements and contractual principles.
Okay, so we've gone deep on the purchase agreement, the RPACA, and those vital contingencies and disclosures. But before a property can even be offered for sale, there's another crucial contract involved: the listing agreement. This defines the relationship between a seller and their agent. How do these work, and what should an aspiring agent really know about them?
Right. If we connect this to the bigger picture, the listing agreement is your foundational blueprint for actually marketing and selling a property for your client. The most common, and generally the most protective type for an agent, is the exclusive right to sell listing agreement. This contract formally hires your brokerage as the exclusive agent to sell the property. And critically, it ensures the broker gets compensated if anyone, that means you, the seller themselves, or another cooperating broker procures a ready, willing, and able buyer during the agreed-upon listing period.
So it protects the agent's commission regardless of who finds the buyer.
Exactly. It provides the broker with the maximum incentive and protection for all their marketing efforts, their time investment, everything they put into selling that property. And a practical tip: before even taking a listing, it's always good practice for an agent to verify that the person signing the listing agreement is indeed the owner of record. Just check the public records.
Saves headaches later.
Oh, definitely. This simple step can avoid a lot of wasted effort and potential legal complications down the line if it turns out they didn't actually have the authority to sell. Now, to give you an illustrative example of how this works in practice, let's talk broker compensation. This can be structured as a percentage of the final sales price or sometimes as a flat fee, but it's a common misconception. It's really important to remember that for 1 to 4 residential units here in California, commission rates are not fixed by law. They are entirely negotiable between the seller and the broker.
So that needs to be clear in the agreement.
Absolutely. It must be explicitly stated in bold print within the listing agreement itself. This reinforces transparency and makes sure the seller understands their rights regarding negotiation. This negotiation is a key part of establishing the agent-client relationship, allowing for flexibility based on market conditions and the level of service being provided. And another key protective clause for brokers, something you definitely want in your listing agreement, is what's known as the safe harbor provision, or sometimes called the broker protection clause. What this clause does is it extends the period for which a broker is entitled to compensation if a buyer they specifically procured during the listing period ultimately buys the property after the initial listing period has actually ended.
So the seller can't just wait a week after the listing expires and sell to the buyer the agent found, cutting the agent out.
Precisely. This provision is designed to prevent sellers from trying to unfairly bypass commissions by just waiting out the contract term to sell to a buyer who was originally introduced or significantly engaged by the broker. It ensures that the broker's efforts, their marketing investment, their time spent showing the property are recognized and compensated even if the deal closes a bit later, as long as that specific buyer was identified and procured during the active listing period. It protects the agent's investment.
Okay, listing agreements covered. Now, beyond the main offer terms in the RPACA, it also addresses practicalities like when the buyer actually takes possession of the property. This might seem like a minor detail, but I imagine it can have significant contractual implications, right? This sounds like an area where misunderstandings could easily pop up.
That's a very perceptive point. Occupancy details are absolutely vital and can indeed lead to complex issues if they're not handled correctly and explicitly in writing. For instance, if the seller needs to remain in possession after the close of escrow, maybe for a few days or weeks.
Like a rent back.
Exactly, a seller rent back. Or, conversely, if the buyer needs to move in early before the title officially transfers. In either situation, a landlord-tenant relationship can inadvertently be established. And this is a critical
Sure.
point because the standard real estate purchase agreement, the RPACA, doesn't inherently cover tenancy law. Creating an unintentional tenancy can bring in a whole new set of legal obligations, protections, and potential eviction rules under landlord-tenant law that neither party probably anticipated or wanted.
So how do you handle that properly?
To prevent these unintended legal consequences, you absolutely need separate written agreements. California Association of Realtors, CAR, has standard forms for this. For a seller staying after closing, you'd use something like the Residential Lease Agreement After Sale, CAR Form RLAS. For a buyer moving in early, you use an Interim Occupancy Agreement, CAR Form IOA 11. These documents clearly define the terms, responsibilities, rent amount, duration, security deposit, etc., ensuring both parties understand their roles beyond just the sale itself. And this is also crucial for insurance purposes. Think about it. The risk of loss, say from a fire or flood, generally shifts to the buyer if they occupy early. The seller's hazard insurance might not cover the property once title transfers or even once someone else occupies it. Imagine the massive headache if a fire broke out the day after early occupancy and nobody had the right insurance coverage in place. These agreements help clarify insurance responsibilities too.
Okay, that makes sense. And what about properties that already have existing tenants when they're sold? That adds another layer of complexity, I would think, especially with California's tenant protection laws.
Absolutely. If the property being sold has existing tenants, the default expectation under the RPACA is that the seller is responsible for delivering the property vacant before the close of escrow, allowing the buyer to do a final inspection on an empty property. This is unless it's explicitly agreed otherwise in writing. This means the seller has to handle all the necessary steps to terminate the tenancy, adhering strictly to the existing lease terms and any applicable local or state rent control laws, and just cause eviction ordinances.
But what if the buyer wants to keep the tenants? Like buying an investment property?
Right. If the tenant is intended to remain, then a specific purchase agreement addendum, like CAR Form PAA, absolutely must be used. This addendum ensures critical things happen. The buyer receives copies of all the existing rental documents, the lease, any notices, tenant applications, proof of security deposit transfer, and it clarifies the terms under which the tenancy will continue post-closing. This addresses potential complexities with rent control laws, estoppel certificates confirming lease terms, or any agreed-upon changes to existing leases. It makes sure the buyer fully understands their new responsibilities as a landlord from day one, inheriting the existing tenancy legally and transparently. It's all about full disclosure on both the property and its current occupants and their rights.
Now let's maybe zoom out a bit. While our main focus today is residential real estate contracts, understanding contractual principles more broadly can make you a much sharper agent, right? Especially for more complex deals, like maybe advising a client on buying a new construction home or investing in a property flip. We have some interesting insights here from the world of drafting large-scale construction contracts. Now, despite being a different industry, they share these powerful, universal principles about managing risk. What are some of these more sophisticated clauses, and what core wisdom do they offer for handling any kind of significant deal?
This is really where understanding the contract as a blueprint expands beyond just the standard residential sale forms. Think about the biggest financial risks in any large project: payment failures, costly delays, hidden defects, or simply who's responsible legally if something goes wrong. The kind of foresight needed to draft a contract for, say, a multi-billion-dollar tunnel project,
Yeah.
anticipating everything from unexpected soil conditions to wild fluctuations in material prices. Well, that embodies the same kind of critical thinking and risk assessment that makes an exceptional real estate agent stand out. Let's look at a few key clauses from construction that manage these risks, and then we'll connect the dots back to your world as a residential agent. First, consider indemnity clauses. These are fundamentally about allocating risk and liability between parties. In construction, a typical indemnity clause might force a subcontractor, for example, to assume all risks and liabilities arising from their specific work. This often includes the duty to defend and hold harmless the general contractor and the property owner from any damages, injuries, or illnesses related to that work.
So one party covers the other's back, legally speaking.
Essentially, yes. From an analysis perspective, this means one party is contractually promising to cover the legal costs and any damages awarded against the other party under certain specified circumstances. It's a very powerful risk-shifting tool.
Okay, but how does that translate for a residential agent? We're not dealing with subcontractors on a tunnel project.
True, you won't be drafting complex indemnity clauses for a standard home sale, but understanding the concept of risk shifting is paramount. When you see a buyer, for instance, being pressured to waive contingencies like the inspection, they are, in effect, partially indemnifying the seller against unknown problems with the property. They're taking on that risk. Or when you advise a client who's planning a major renovation after purchase, you need to help them understand whose insurance covers potential damage during construction, who bears the risk if the contractor makes a costly mistake. This principle teaches you to constantly ask, who is taking on the risk here? Is it explicit? And are they adequately protected either through the contract or insurance? It's about identifying where the risk lies.
Okay, risk shifting. That makes sense. What's another principle?
Next, let's talk about liquidated damages. These are provisions that predetermine a specific amount of money to be paid as damages if one party fails to meet certain key contractual requirements. Most commonly, this applies to failing to complete a project on time or maybe failing to meet specific performance criteria. They're typically expressed as a set amount of dollars per day for each day of delay. For example, a construction contract might clearly state, contractor shall pay owner $500 per day for each calendar day of delay beyond the agreed completion date as liquidated damages.
So it avoids arguments later about how much the delay actually cost.
Exactly. The ultimate purpose of liquidated damages is to avoid those difficult, often contentious calculations of actual losses by agreeing on a fair and reasonable estimate up front. It's meant to reduce future litigation over the precise amount of damages suffered due to the breach. Now, for a residential agent, how does this apply? Your standard purchase agreement, the RPACA, might not have a daily penalty clause for a delayed closing in the same way. However, understanding liquidated damages helps you grasp why the earnest money deposit is so crucial and why the contract often specifies it can be retained by the seller if the buyer defaults without a valid reason.
Ah, so the deposit acts like pre-agreed damages.
In many ways, yes, especially if the liquidated damages clause pertaining to the deposit is initialed by both parties. It functions as a predetermined amount of damages in case a buyer breaches the contract. It's a similar concept, predetermining financial consequences to incentivize performance and simplify dispute resolution if things go wrong.
Interesting connection. What else from the construction world?
Finally, let's touch on material escalation clauses. This is really relevant today. Traditionally, the risk of price increases for construction materials was generally viewed as something the contractor just had to absorb, part of their business risk. However, recent global events, think COVID-19, major supply chain disruptions, have drastically changed this landscape. We saw lumber prices skyrocket, steel prices jump. These clauses allow a contractor to shift the risk of significant unforeseen material price increases or even substantial delivery delays back to the property owner.
So the owner might end up paying more than the original contract price.
Potentially, yes, if certain triggers defined in the clause are met. What does this mean for you as a residential agent? Again, you probably won't be drafting these clauses for a standard resale, but understanding them teaches you how even the fine print can drastically shift financial risk, especially in situations involving construction or renovation. If you're advising a client on buying a new build from a developer or helping someone buy a fixer-upper where major renovations are planned, recognizing where these cost escalation risks might lie, especially for key materials like lumber, concrete, or roofing, becomes incredibly important. You'd want to advise your client to understand their builder's contract terms very carefully. Does the builder guarantee the price? Or do they have an escalation clause that could dramatically increase the final cost if material prices spike? It's about spotting those potential hidden financial exposures that can completely blow a client's budget.
So what this all really means for an agent, it sounds like, is that even if you're primarily dealing with standard residential sales, understanding these deeper principles from other complex contracts, like construction, gives you an incredible edge. It helps when advising clients on new builds or investment flips, or even just recognizing potential red flags in more unique situations. It's about spotting those underlying patterns of risk and responsibility, isn't it? It's like learning to read between the lines, not just on a multi-billion-dollar tunnel contract, but on your client's next purchase offer or listing agreement.
You've captured the essence perfectly. That's exactly it. What's fascinating here is how these core principles Careful risk allocation, clear definitions of damages and consequences, meticulous handling of timelines and external documents are truly universal. They transcend specific industries. The same kind of critical thinking and foresight needed to draft that complex construction contract is invaluable for an exceptional real estate agent. Understanding these nuances empowers you to advise clients not just on the standard clauses in the RPACA, but to anticipate and navigate the complexities that can arise in any real estate deal. Whether it's a simple condo sale or a multi-million-dollar development project or advising on a new custom build, it allows you to spot potential issues before they become major problems, to effectively manage your clients' expectations, and to offer proactive solutions. This deep understanding builds immense trust and strengthens your professional relationships. It allows you to adapt confidently to diverse client needs and shifting market challenges with a much deeper level of expertise. You really move beyond just processing paperwork to truly strategizing for your client's best interests and protecting them effectively.
Navigating the dance assignment, cancellation, and dispute resolution.
Okay, so we have a contract in place, hopefully well drafted, but sometimes circumstances change unexpectedly, right? A party might need to transfer their rights to someone else, or in rarer, more difficult cases, maybe even cancel the agreement altogether. What are the rules around assignable contracts and unilateral cancellation in California? That sounds like it could be a legal minefield.
That's a critical question, dealing with flexibility and sometimes necessary problem solving within real estate transactions. Let's take assignability first. Many California real estate contracts can potentially be assignable. This means one party, called the assignor, can transfer their rights and also their responsibilities under the contract to another third party, the assignee. This is actually quite commonly used in the world of real estate investing. For instance, an investor might secure a property under contract at a certain price and then assign that contract to another end buyer, often for a fee, before the original contract closes.
But it's not automatic. You can't just decide to assign it.
No, definitely not automatic. You must always check the contract itself for an explicit assignment clause. Does it permit assignment? Does it require seller consent? Or does it maybe even prohibit assignment altogether? If the contract is silent or prohibits it, you'll almost certainly need the seller's explicit written consent to proceed with an assignment. And the transfer of rights and obligations must be clearly outlined in a separate assignment agreement to avoid any legal complications. Remember, the seller initially relied on the financial resources and perceived reliability of the original buyer when they accepted the offer, so they usually have a say if that buyer is changing.
Okay, so assignment is possible but needs checking. What about just canceling a contract without the other party's agreement, unilaterally pulling the plug? That does sound risky, like potentially breaching the contract.
Unilateral cancellation is indeed very tricky and can definitely lead to severe legal consequences if it's not executed precisely according to the terms spelled out in the contract and the relevant California law. California law generally permits it only under specific, defined conditions. These usually serve as safeguards when one party's fundamental expectations or contractual protections are not being met. The most common and usually the clearest ground for a buyer's unilateral cancellation is based on unfulfilled contingencies. If a contingency like the home inspection reveals significant defects the buyer isn't willing to accept, or the buyer is unable to secure the necessary financing within the agreed timeframe isn't met or waived, the buyer often has clear grounds under the contract to cancel without penalty and get their earnest money back. This is precisely why those contingencies are negotiated into the contract in the first place. They are predefined escape clauses.
What about other reasons, like if the other side isn't holding up their end?
Right, another potential ground stems from breaches of contract. If one party simply fails to perform their agreed-upon obligations, as outlined in the contract, for instance, the seller doesn't provide the required disclosures on time, or maybe fails to make repairs they agreed to make, the non-breaching party might have grounds for cancellation. Similarly, although less common, if there's clear evidence of significant agent misconduct, maybe an agent engaging in deliberate misrepresentation or failing to disclose a known material fact that they were legally obligated to disclose, this could potentially be grounds for their client to seek cancellation of the contract. Documenting any such misconduct thoroughly would be absolutely key to substantiating such a claim.
What about just life changes, like losing a job?
That's a tough one. A significant change in circumstances in a party's personal life, like a certain job loss or a major health issue, while certainly sympathetic, does not usually provide an automatic legal right to unilaterally cancel a binding contract. However, it can certainly influence negotiations. While it doesn't give you a legal out on its own, open communication and a willingness from both sides to renegotiate terms might lead to a mutual agreement to cancel or modify the contract. But if no mutually agreeable solution is reached, legal advice is almost always necessary. An attorney can help explore possible options and explain the potential ramifications, the risks of attempting to cancel without clear contractual grounds. My strong advice to you, the listener, is always consult with a qualified real estate attorney before attempting any kind of unilateral cancellation. Doing it without proper grounds can lead to significant disputes, severe financial penalties, including potentially forfeiting the earnest money deposit, or even facing a lawsuit for damages or specific performance. The stakes are very high.
Okay, so tread very carefully with cancellation. Now, if a contingency deadline is missed or a party isn't fulfilling their obligations on time, there are specific forms agents use to formally push the transaction forward or potentially trigger those cancellation rights we just discussed, right? It's not just making a phone call or sending an email.
Yes, exactly. These formal notices are critical tools for managing timelines and ensuring accountability within a real estate transaction. They formalize the communication and create that essential paper trail. The notice to buyer to perform, often abbreviated as NBP, is a common form used by the seller. This is issued if the buyer hasn't completed certain required actions, most commonly removing their contingencies like the inspection or loan contingency, or maybe hasn't made a required deposit increase within the time frame agreed upon in the contract. The NBP typically gives the buyer a set period, often at least 24 hours, but check the contract, to comply with the specified action.
And if they don't comply after the notice?
If the buyer still doesn't perform after receiving this formal notice and the specified time expires, the seller then generally has the legal right under the contract to unilaterally cancel the agreement. And depending on the specifics and whether liquidated damages were agreed to, they may potentially retain the buyer's earnest money deposit.
And is there a reverse version for buyers too, to put similar pressure on the seller if they are dragging their feet?
That's right. There's the notice to seller to perform, NSP. This is the tool used by the buyer. The buyer issues an NSP to put the seller on formal notice if the seller hasn't met their contractual obligations within the agreed timeframes. This could include things like failing to provide required reports, like a pest inspection report, or mandated disclosures, or maybe not completing agreed-upon repairs. Now, while the NSP doesn't automatically lead to immediate cancellation rights for the buyer in the same direct way an unheeded NBP does for the seller, it serves a crucial purpose. It formally documents the seller's failure to perform. This documentation can significantly influence the buyer's decision on whether or not to remove their own contingencies. Why commit further if the seller isn't performing? Or it can provide strong grounds for future legal action if the seller ultimately defaults on the contract.
So these notices are really about accountability and creating a record?
Exactly.
Yeah.
For analysis, these notices are absolutely vital. They do several key things. They formalize the communication, moving beyond informal reminders. They create a clear and undeniable paper trail documenting who was asked to do what, by when, and whether they did it. They ensure that deadlines and obligations are acknowledged and taken seriously. It's really about active transaction management, not just passively waiting and hoping things happen. They push the deal forward by clearly demanding performance, bringing potential issues or delays to a head before they fester into major disputes or derail the closing. They are essential for demonstrating good faith efforts by the party issuing the notice and for establishing clear legal standing should a dispute unfortunately end up requiring mediation or arbitration down the line.
Which brings us to that point. Even with the best contracts and diligent agents, sometimes disputes do arise. The RPACA you mentioned often includes clauses for how these disagreements will be handled, ideally outside of a full-blown court battle. What are the common methods, and what's the real difference between mediation and arbitration?
Right. Most modern California real estate contracts, definitely including the standard CAR forms like the RPACA, strongly emphasize alternative dispute resolution ADR before anyone resorts to traditional litigation in court. The whole idea behind this is generally to save time, save money, and reduce the emotional stress for everyone involved, which is a huge potential benefit for your clients compared to going straight to court. Mediation is typically the required first step for most disputes arising out of the purchase agreement or even the listing agreement. In mediation, a neutral third party, called a mediator, facilitates discussions between the disagreeing parties, like the buyer and seller or seller and agent. The goal is to help them voluntarily reach their own resolution. Critically, the mediator doesn't make any decisions or impose a solution. Their role is purely to help the parties communicate effectively, understand each other's perspectives, explore the issues, brainstorm options, and hopefully find some common ground leading to a mutually agreeable settlement. And there's a big incentive to try mediation first. If a party is required by the contract to mediate, but refuses, and instead goes straight to court, they can be barred from recovering their attorney's fees later, even if they ultimately win the case.
Wow, that's a strong incentive.
It really is. So mediation is truly about finding a cooperative resolution and potentially keeping the relationship intact if possible.
Okay, so mediation is first and voluntary. What about arbitration? That sounds more formal.
Arbitration, on the other hand, is usually an optional clause within the contract. For it to be binding, it must be specifically initialed by both parties. You can't be forced into arbitration unless you agreed to it beforehand by initialing that specific clause. If both parties do elect for arbitration by initialing it, they are essentially agreeing to submit any future disputes to an agreed-upon neutral arbitrator, or sometimes a panel of arbitrators, instead of going to a judge or jury in a formal court setting. The arbitrator acts much like a private judge. They'll hear evidence and arguments presented by both sides, and then they will render a decision, which is called an award. This decision is generally legally binding and final. It can only be appealed or set aside by a court in very limited circumstances, such as proven fraud or corruption on the part of the arbitrator, or a serious failure of due process during the hearing.
So it's faster, but you give up some rights.
That's the trade-off. Arbitration is typically faster and less formal than court litigation, which can save time and money. But a key consequence is that it significantly limits your rights to appeal the decision if you disagree with the outcome. So while it offers a potentially quicker, more private resolution, it sacrifices some of the procedural safeguards and the broader appeal avenues available through the public court system.
Got it. So it really sounds like these contracts are truly the blueprint for absolutely everything related to the deal, not just the initial sale terms, but how you handle bumps along the road, and even how you resolve disagreements if the whole dance goes completely off script.
That's a great way to put it. If we connect this back to the bigger picture for aspiring agents listening, mastering these aspects of real estate contracts means you're not just facilitating a transaction, pushing paper. You're providing comprehensive protection and clear, knowledgeable guidance to your clients from the very beginning, through the middle's potential complexities right to the end, and even addressing what happens if disputes arise after closing. Understanding the nuances of offer and acceptance, the power and proper use of contingencies, the critical importance of disclosures, the mechanisms for enforcing timelines like notices to perform, and how disputes are ultimately resolved. Well, it transforms an agent from a mere facilitator into a genuine strategic advisor. This deep understanding builds immense trust and strengthens your professional relationships immeasurably. It allows you to adapt effectively to diverse client needs and navigate unexpected market challenges with real confidence. You become that knowledgeable, reliable guide your clients absolutely depend on when making what is often the largest, most significant financial transaction of their lives. You provide expertise and invaluable assurance. Outro.
Wow, okay. That was definitely a deep dive into the blueprint of real estate deals. We've really seen how those essential elements like offer, acceptance, legality, and consideration form the absolute bedrock of any contract, ensuring that a simple handshake actually becomes a legally binding commitment on paper. We've explored the power of buyer protections through all those different contingencies, from the critical home inspections to securing financing, and learned why California's unique disclosure requirements and those contingency removal forms are such non-negotiable safeguards for everyone involved. And we even looked at how understanding complex principles from other industries, like risk shifting and defining damages clearly, can sharpen your approach to risk and negotiation in any major real estate transaction you handle. Hopefully, you are now truly on your way to becoming a contract conductor.
And perhaps this raises an important question for you, the listener, to consider as you move forward in your real estate journey. In this rapidly evolving market we're always talking about, how might future innovations, maybe in technology, like using blockchain for more transparent record keeping, or maybe significant shifts in environmental regulations regarding climate risk or energy efficiency, how might those impact the fundamental clauses and contingencies we've discussed today? Will new types of disclosures become paramount as our understanding of property and its surrounding environment continues to expand? Something to think about.
That's a fantastic thought to ponder, definitely food for thought. As you continue on your journey, remember to revisit this blueprint. Review your notes from today, Practice spotting these clauses in sample forms, maybe role-play negotiations, and, crucially, never shy away from recommending or seeking expert legal advice when a situation gets complex or requires it. Next time, we'll shift our focus to the intricate world of real estate financing, understanding different loan programs, the pre-approval process, and how grasping financing can help you unlock those homeownership dreams for your clients. Thank you so much for joining us on the deep dive. If you found this deep dive valuable, please share it with anyone else you know who's aspiring to master the world of real estate. And be sure to subscribe to our deep dives to ensure you don't miss out on more shortcuts to being well informed and successful in your career.